Okay, this is about a year ago this was enacted by Congress. And it was I should start by saying that I joined the first CPA firm I worked for when I was still a sophomore in college. I've been working in the tax area ever since, which is a few years.
It's almost 100.
You're a very good mathematician.
Oh, yeah.
Yeah.
Thank you, Ron.
And this is the first tax legislation that was ever passed in my knowledge, in my experience, where there were no congressional hearings, for outside input. It was all done behind closed doors and signed, and we have this. So as a result, Congress has spent the last year trying to fix a lot of things, totally unsuccessful to date. They sent a lot of it, they delegated the Internal Revenue Commissioner, IRS, to write the regulations, and they didn't even know where to start. It was terrible. The Trump Tax Cuts and Jobs Act is this is symbolic. This is 1,101 pages, approximately. That's the Jobs Act. There's one section here alone that's one page. I'll get to it later. But the IRS wrote 175 pages of regulation just to explain this one section of the tax law. So that's what we're dealing with. A lot of it is poorly drafted. It has a lot of unintended consequences, but it's the law we are dealing with. So it's 111 pages, and we have about an hour, plus or minus or so, as long as you can stay awake, to go over this. So we're just going to obviously touch on some highlights, but I'll try to bring into it what still may be an opportunity for some quick year-end planning if you still have any thoughts, plus ongoing. There are many changes. A lot of the changes were effective January 1, 2018. Some started in for 2019, and we'll get into some of that. Some of the provisions primarily affecting individuals sunset in 2025, and they revert back to where it was in 2016. The entire Tax Cuts and Jobs Act is business-centric and top 1% centric. And the rest of us who are in those of us who are in the 99%, were given some crumbs. But as you'll see as we go through this summary, what the IRS, what the Trump tax law gave us with one hand, they took back in the other. So there's a lot of studies done. One Republican congressman was on the Morning Joe last week, and he said in his district, the average person is getting $2,100 back. Nationwide, the number is that $800 back. So, as I said, most of the changes are temporary for individuals. Guidance is needed. Guidance is needed for Congress to correct a lot of things. There's definitely going to be future legislation. It's been tried already. Nothing has really gotten through that's going to stick. And every state, all 50 states, start with your federal return, and they have their own rules. And Vermont has a lot of its own rules that have been changed this year too, and we'll go over some of those at the end. The basics. We had 7 different brackets, and now we still do have 7 different brackets, but they've been changed somewhat. The 2 lower brackets of the 10 and the 12%, the 10% bracket is basically for a taxpayer with under $9,000 of income. And the 12% bracket goes up to about $70-some-odd thousand. However, the real significance here is the top bracket, the 37% bracket. The top bracket used to be, last year, 39.6%. And that was for taxable incomes around $400,000 or $500,000 for a married couple. The 37, not only did the top bracket go down 2.6%, but the bracket goes up to almost $1 million. So, actually, yeah, it's over. Well, it's the top bracket, so everything over 400,000 is going to be at 37%. So the 1%ers are really doing very well on this. We've all been used to, over the years, of taking personal exemptions for ourselves, for our kids, for the people that camp out in the house. Some people take for their dogs, you know, all the loved ones. And these are entirely out. We have no longer are we having any deductions for personal exemptions. That's gone. For people with children, and this includes children up through college age, there is now an increased child tax credit up to $2,000, which is very significant for a young family with a few kids. And up to $1,400 of that $2,000 per child is refundable. It's a refundable credit, meaning that after your taxes are wiped out, if you still have unused credit, you can get a refund, up to $1,400. They also put in here a $500 credit, and this is a new concept, a $500 credit for a non-child dependent. So if you have a mother-in-law, father-in-law, a nephew, somebody else who would ordinarily qualify as a dependent under the tax law, even though we no longer have dependency exemptions, you can get a $500 non-refundable credit for each of those people, which is nice. The standard deduction has been increased to, for a single person, $6,000, for a married couple, $12,000. I mean, yeah, I'm sorry, for a, yeah, $12,000 for a married couple, but that's, but for a married couple filing a joint return, there would be a $24,000 standard deduction. If you're over 60, either 2 or 5, I forget, you get an extra $1,300. So seniors over 65 can get a $26,600 standard deduction. These are things you can't plan around. These are all just statutory calculations, and they just, you know, it falls when you prepare the return. AMT, alternative minimum tax. This was put into the law back in the Reagan years, where you remember Ronald Reagan said everybody should pay their fair share of taxes, and even the rich shall pay their fair share. An alternative minimum tax was put in that everybody paid on certain preference items a tax of 28%. And there was about a $40,000 exemption for that. That has been changed to, it's all but been eliminated. The exemption now is close to $1 million, so only the very wealthy is going to pay any alternative minimum tax. And that was a big thing, especially in coastal states where you have high real estate taxes and income taxes. By the way, we're a relatively small group. If you have any questions as we go along, we may. Yes, James.
Did I hear you say correctly that the 12% tax bracket is up to $70,000?
Yeah. I don't memorize rates; they change all the time. But for a married filing joint, well, for a single person, the 10% rate is $0 to $9,500, and then from $9,500 to $38,000, it's 12%. For a married couple, it's 10% is for the first $19,000, and over that, up to $77,000 is 12%, which is a pretty low rate. Then the next bracket goes to 22. The brackets are 10, 12, then it jumps to 22, but that's a big jump, and 24, then 32, and 35 and 37. And at 37, it's everything over $600,000 is a 37%. Which, you know, the rates have been brought down, but also deductions have been tossed out. The nice news is that the preferred tax rate on qualified dividends and long-term capital gains has been kept intact at basically the 15%. A qualified dividend is a dividend from what is generally a public company, like Mobil, Exxon, AT&T, versus a dividend from a privately held company. And that's a special tax rate. However, the rate for long-term capital gain and qualified dividends on the first if your taxable income is less than $77,000, and that's for a married filing joint, there's no tax on qualified dividends and long-term capital gains. I have clients with, say, $100,000 of income, but mostly from dividends and capital gains, there's no tax. So this is a nice thing. And from the 15% rate was preserved on married filing joint. This is wonderful, from $77,000 all the way up to $479,000. That's a pretty big tranche of taxable income. That covers a lot of people. Yes?
What about single?
Single? Roughly half of that. Let me see if I have it here. For single, it's 0 up to 38.6, which is half, and it's 15% between, well, this is good, between 38,000 and 425,000, which is very good. So, fairly for most people, the 15% bracket rate is going to be applicable for long-term capital gains. This is very good. And then, if you have taxable income of over $479,000 if you're married filing joint, or $425,000 for single, it's a 20% capital gain rate and dividend rate. But if you're also in that category, the special Medicare tax under Obamacare on net investment income also kicks in at another 3.8%. So if you have $500,000 of taxable income, your long-term capital gain rate is effectively 23.8%. Okay? This is very good. This is in planning your income for the year. This is good to know on when should I take a capital gain now or wait till January. This is good to know. Itemized deductions. You mentioned what happens to itemized deductions. This is where they give you an increased standard deduction, but they take away a lot of your itemized. IRS estimated that about 40% of the tax returns itemized deductions up through 16. This year, less than 10% of taxpayers will actually itemize deductions. And the reason why is because the standard deduction will be higher than what you could get if you're itemized, because of all the changes made to allowable itemized deductions. Medical expenses, they're still good, but it used to be everything over 7.5% of your adjusted gross income could be deductible. It could be includable as a deduction for medical. Starting next year, it's going to be 10%. So they're whittling away a little bit of that. But for the most part, medical expenses are pretty much the same as they were before. Mortgage interest. Mortgage interest on all real estate transactions that exist currently up through the end of this year remain intact. You can still take interest deductions on a mortgage. Hi, Linda. How are you?
Good. I'm so sorry.
No, that's okay. You haven't you haven't missed much. So right now, the current law, which is still in effect for another 15, 20 days, is you can take interest on the first $1 million of your mortgage and another interest on a $100,000 home equity loan. And you can use that home equity loan for anything you want to spend it on. Starting in January, starting in January, that debt prior to 17, I think, is grandfathered, but I think it was also extended to 18. Starting in January, on new purchases, you can only deduct interest on a $750,000 acquisition mortgage, an acquisition to purchase and or to improve a new residence. If you refinance next year, you can only take interest up through the $750,000 refinanced amount, even if your mortgage was higher. You're going to lose that. And no longer will interest on home equity loans be deductible at all. Okay, that's out. This is one of the factors that's putting a little cloud over the real estate industry right now. People, why think houses in this market aren't selling as much. I know I'm familiar with New Canaan, Connecticut, and people tell me down there that because they're all the houses are over 750 that you would want to buy, and the market's not very hot. The real rub, can you see all right? The real rub, I don't want to be walking in front of you. The real rub is the limitation of the deduction of SALT taxes, S-A-L-T, state and local taxes, state income taxes, state and local real estate taxes, sales taxes are limited to a flat $10,000.
Across all of them?
Yes. $10,000 is the limit. Now, we here in Vermont, the average person probably has more than $10,000. If you own a house, you got more than $10,000 of real estate taxes, state and local income taxes, and sales taxes. But it's $10,000 for a single, $10,000 for a married filing joint. This is one of the reasons why people...
Filing single.
For a single person, it's $10,000. For a married couple, it's $10,000. For a married filing single, it's $5,000. You rarely see married filing single, unless one spouse was advised that you don't want to be legally involved with what the husband or the wife is doing. It's easier to file a return married filing separately. That means separately, rather than have to go through a innocent spouse claim. IRS says, what's an innocent spouse? There ain't none. Form for it if you are. But that's the problem, because we are so limited in on this $10,000 limitation for state and local taxes. That's why a lot of people are going to be taking the standard deduction. And it's odd that I don't want to. If I say anything that may be political, it's not intended to be political, because I try not to be political in my work. However, it's the blue states that are hit hardest with this. Unfortunately, California is the #1 tax state. New York, Vermont. New Hampshire is borderline. They don't have a sales tax or income tax, but they have heavy real estate taxes. However, with complexities, there's always loopholes, and there's ways to benefit. And we'll get into some of those opportunities. The other big rub is other itemized deductions subject to the 2% of AGI limitation. And this is hitting home. Your tax preparation fees are no longer deductible. Your investment advisory fees are no longer deductible. I'd say to my clients, well, if we take our fees out of your IRA, it's in effect getting a deduction anyway, but not on your brokerage account. And this is also bad, the unreimbursed employee business expenses. Nurses who pay for their own license and training can't deduct it anymore. Your safe deposit box, not that that's going to change anybody's net worth, in not being able to deduct a safe deposit box, but it's no more itemized deductions subject to the 2%, and most of them were 2%ers. Okay? And in fact, here's some examples. This is what I just, unreimbursed employee business expenses, hobby expenses, investment fees and expenses, legal fees for the preservation of your income-producing assets, safe deposit, all out. None of these are deductible. So, with most of my clients who in Fisher Financial, who were an investment advisory firm, have investments. So between the investment advisory fees and not being able to deduct state and local taxes, there's not a lot left. If you're a married couple with more than $26,000 of medical expenses, I mean, you're going to be in a nursing home, right? That's why the standard deduction. As I said, yes. Yes.
Just a point of reference. That's why, because of all these deductions, there have been a couple of studies done by independent sources during this past year, especially toward the end of the year, which indicated that those averages of 1,400 that you mentioned earlier and 800 are extremely deceptive, because, as you know, averages also include people who will owe money that didn't think they would. Mm-hmm. So that the conclusion on this was that the larger standard deduction may in fact not make up for all of the other things that were eliminated.
No, right. So it doesn't.
That the majority of people, those under the 1%, will in fact owe when they thought they wouldn't. Well,
studies were done where the average American will save about $800. Now, that means some will save more, some will save less. It all depends upon, in part, where you live, what state you live in. I mean, it's. But there's still opportunities with all this. There's still opportunities that we'll get into. Yes, that was a good comment. Thank you. The 20%, as I started off, I said this entire tax legislation was business-centric and 1% centric. And the biggest thing that we heard in the press was that corporate taxation was going to be reduced, the rate was going to be reduced from 35% down to 21%. This was big. This was enormous. And, of course, the corporations were going to give everybody raises. It stopped at the corner office, though. Started and stopped at the corner office. And part of the good year in the stock market this past year was increased earnings. And part of those increased earnings came from tax savings. Mm-hmm. So, and there's also studies that it hasn't really fully kicked in yet. So there's opportunities in growth that way. However, what about all those businesses that aren't big public corporations that pay 35%? What about all these Subchapter S corporations and partnerships and sole proprietorships and LLCs, limited liability companies, which is many multiples in number than there are major corporations. So to satisfy the people who are self-employed or in smaller businesses, and Sub-S is a corporation that's passed. In other words, the pass-through businesses where you don't pay tax at the business level, but it's brought back onto your personal return, like a partnership or through a K1 on a Sub-S or a sole proprietorship. Where it's where you have a Schedule C on your return. This concept was put in, the 20% pass-through deduction. James?
Isn't this the one that you were talking about? They wrote 175 pages just to explain?
Yes, exactly. Congress put this in, not exactly at the last minute, but after some people started to complain. It was basically one page, but it's 175 pages of proposed regulations trying to explain it. and it's complicated. Basically, for those business people who are other than public companies, paying 21% of the, regular, what they call C companies, C corps, other businesses can deduct 20% of their taxable income as just another deduction. It's called a pass-through deduction. Qualified business income deduction is what it's called. And it's not even taken on the business return, it's taken on your personal 1040, because there are limitations of your own taxable income and other ceilings as well.
Would that show up on a schedule?
Sorry?
Would that show up on a Schedule C for us?
Well, if you have a sole proprietorship on a Schedule C, the 20% pass-through deduction is actually backed onto page 1 of your 1040, because it's the taxable income on your return. That's also a limitation. Another little thing, I don't have it with me, but President Trump was saying, you can file on a postcard. Well, IRS has changed the form where it's virtually the size of a large postcard. But the fine print says, if you have anything to report, attach a schedule, and the average person is going to have 20 schedules. But it is a postcard. You can't mail it in as a postcard. But yes, sir.
So if I understand this correctly, if you have a subchapter S corporation, and let's say you make $100,000 of income from that, your taxable income is only 80?
Yes and no. Yes, in a very simplified way, that's approximately correct. But then if your taxable income, if your final taxable income is lower, it would be 20% of the lower, and because of deductions and.
So if your
But
corporate pass-through income is 100, and you take the $26,500 married filing jointly senior deduction, now you're down to 73.5. You don't get the 20% anymore.
No, it would be lower. It would be
You get 20 plus the 26. 20% plus the 26.5.
It would be lower than, it would be 20% of your taxable income is the limitation. The starting point is 20% of your business income, but then there's a lot of calculations. And also, there's a phase out. There's a phase out of this deduction. If you are in a personal service business, or if you are in a business where your reputation brings in the customers, you start getting phased out of this 20% once you're on a married filing separately, on a married filing joint. Once you hit $315,000 of taxable income, it gets phased out. And I think it's about $430,000 is completely phased out. So I was giving this talk last month at Chester Rotary, and Bill Dakin, Bill Dakin is a lawyer over in Chester. So I said to Bill, if he changes his advertising, where he has no skills and he has a very bad reputation, he may be able to get a loophole. But he said, I don't think that would work for me. So anyway, I don't want to spend a lot of time on this. If you are in business and you may be subject to the availability of this 20% special deduction, you must speak to your tax advisor. It's complicated. It has a lot of, give it here and take it back here, a lot of restrictions, a lot of limitations. If you have a subchapter S, for example, and if your $100,000 of income from that subchapter S was taken as an $80,000 salary and $20,000 as deemed earnings distributed as a dividend, only that $20,000 is subject to this 20%, not your $100,000. So a lot of people on with sub-S's are required to take a salary. The salary doesn't qualify. This does not include reasonable compensation paid from a S-corp or guaranteed payment on a partnership because that's considered compensation. And it's only the profits. So again, the fine print is not there to help you. Okay? and the phase out. So again, this is complicated. The Vermont Society of CPAs had an 8-hour seminar just on this one little thing, and we just scratched the surface, you know. Affordable Care Act. There is no longer a penalty to maintain insurance under the Affordable Care Act. However, you are still required to have insurance under the Affordable Care Act. There's just no penalty. So where is the enforcement bite? Okay, we're not going to spend any time on that. I discussed briefly that if a single person has over $200,000 of adjusted gross income and a married filing joint return has over $250,000 of adjusted gross income, any investment income over those thresholds are subject to an additional 3.8% on net investment income taxes. This was actually called, this came through Obamacare, and it was to raise money to pay for Medicaid. And it's called the Medicaid tax, you know, generally, basically, but it evolved into the net investment income tax. It's an additional tax. So if you're a married filing joint, you have $250,000 of adjusted gross income, and included in that is $50,000 of dividends. There's no additional tax because you're not over that $250,000. If you have $300,000 of adjusted gross income, you have $50,000, and you have $50,000 of investment income. There's this extra tax on that $50,000. Another example: if you have $260,000 of adjusted gross income and still the $50,000 of dividends, only $10,000 over that $250,000 threshold is subject to this. This is again a statutory calculation. You're not going to not invest in dividend producing securities because of this tax. This is just another layer of money grabbing. Okay? Yes?
A quick question. So there's no penalty for not having insurance?
That's my understanding.
Okay. So for the amount of money that you put into your plan, is there any? You have to pay for your insurance plan. Pay for your plan.
Okay. Okay.
So let's say you're paying $250 a month for a plan that medical.
Was that like a nursing home?
Plan.
Nursing home? Or what?
No, your regular insurance.
Health insurance. Okay.
Right.
Yeah.
Is there anything that comes back in credit for people who pay for their insurance? Is there any tax credit?
I don't know. I don't know anything about that. The only thing I know is that it's all deductible, but I don't know about the credits coming back for that. I don't deal in that. Sorry not to answer your question.
I just thought that since there was a penalty.
There's no longer a penalty for not having. You are still required to have insurance, but there's no penalty for not having it. If you are subject to this tax on the net investment income, the tax is going to be slightly higher in effect because you no longer have the deductions against this investment. You no longer have deductible investment expenses such as advisory fees and things like that. And also you no longer can deduct the state taxes that were paid on your investment income. So therefore your net investment income tax would be slightly higher, but this again is not material. AMT, the main thing here is there's an increase in the exemption of AMT up to about $1 million, so not too many people are going to be hit with that. The vast majority of the clients that I've had over the years that were subject to AMT were people who had high levels of state and local taxes, state and local income taxes, and but we don't have that anymore. So not only is the exemption higher, you're not even going to be subject to it for the most part. Retirement planning. If you are a participant in a company employer-sponsored retirement plan, a 401k, and the plan provided, as most do, for a loan to be taken out. If you had an outstanding loan at the time you severed your employment relationship, that was triggered as a deemed distribution and taxable. That was a hardship. So that was changed. So if a person is in that situation where they are leaving an employment, where they have borrowed money against their 401k or 403b, or an employer plan, you have until the following October 15th to either repay that loan or take it as income. It was a relief provision. It was a hardship for a lot of people who either lost their job or quit, and they had to quit for some reason, and they had this loan outstanding, and they were stuck with taxable income. It's not a forgiveness. It's just a deferment and a relief. The other thing is, and this was a real problem in planning. For clients who have IRAs, individual retirement accounts, and also for 401ks, but mostly for IRAs, there was an opportunity to have a Roth conversion. In other words, you could, if you had, let's say you had $100,000 in your IRA, and you wanted to take $10,000 out and move it over to a Roth. That was converting your IRA to a Roth. It was called a Roth conversion. And that is a taxable transaction. It's a qualifying distribution out of your IRA, which is ordinary income. Of course, the advantage of that is it goes into what will be forever a tax-free shell of the Roth. So what a lot of we worked every year with many of our clients, and let's say we converted $100,000 over to a Roth. We had, under the old law, until the following October 15th, that's the final due date on extension of filing your tax return. You had until that following October 15th to recharacterize and bring back some of that Roth conversion, because you may have overestimated, and that they put you in a higher bracket than you thought you were going to be in, so you could bring something back. That's no longer allowed. Now, starting 2018, if you convert any of your IRA to a Roth, it's locked in. There's no look back. Okay, so you have to be so we're working with our clients now. I still have some I'm working with to make sure that we don't convert so much where they're going to be in those top brackets. In fact, what I'm doing with almost everybody, I'm filling up those 10. I'm filling up everybody's 12% bracket. I don't want to jump from 12 to 22. They'll be unhappy. But in some cases, they don't want to go to the 34. So everybody has an individual situation. But we have to be very careful. I'm so happy that I was able to get my 2018 tax software early enough so I could fine-tune the amount of the conversions, because there's no look back, there's no recharacterization. Yes, sir.
Quickly say I'm sort of ignorant, some of this, what the advantages of doing a Roth conversion were.
Absolutely. This a Roth IRA is one of the last slices of white bread that we have. It's a wonderful tax planning and estate planning tool. When I say estate planning, it's planning for the family's net worth. Not just the account holder, but the family's net worth, the multi-generational net worth of the family. That's what estate planning is all about. It's maximizing the family's net worth. A Roth is an account, it's a retirement account where any contributions are non-tax deductible, and forever the income generated within the Roth is tax-free. It's deferred in an IRA, but it's free in a Roth. Any distributions are tax-free. But more important than almost anything else that I find the clients really get excited about is that an inherited Roth IRA is tax-free to the beneficiary. Whereas a regular IRA, you get a deduction up front, and the income generated within it is deferred, and it all comes out as ordinary income, not 15% rate, or free rate, or even 20%, or 3.8%. It could be 37%, you know? So, and then when it's inherited by somebody, it's fully taxable to the beneficiary. And an average person, let's say you're 85 and you pass away, and you're giving it to your children. Your children are in their 50s. They're in their high income years, and they have to start taking distributions from an inherited IRA in their high. So where's all the money you saved? It's going away, you know. So a Roth is wonderful. So did I answer that question?
Yes.
Okay. Yes, James.
Did I hear you correctly? Did you say that the money that you put into a Roth IRA is not deductible?
It is a non-deductible IRA retirement plan. IRAs have been around for 40 some odd years. I don't know when it started. But the Roth started became effective January 1, 1998. It was with the 1997 Tax Reconciliation Act. And quick little story. In those days, in 1990, Congress passed legislation, which was again passed again. I think it was in 02 or something like that, where any tax legislation had to be revenue neutral. If you reduced taxes somewhere, you had to raise taxes someplace else. This was 1990. Trump law is still law, but they put that one aside with this one. This bill cost over like $1.5 billion, you know, or $1.5 trillion rather, $1.5 trillion unpaid for. They said they'll get to the other side at some point. Anyway, let me just yes, sir.
No, just a point on the Roth.
Oh yeah, the Roth. So
You pay your tax when you create it.
you said?
You have to pay the tax on it when you create it.
Well, you don't really pay a tax when you create it. You can make a contribution to it, but you don't get a deduction for it.
That's right.
It's coming out of after-tax earnings from your salary or some other source. But in 1997, during the Senate Finance Committee meetings, this law of having a revenue-neutral legislation was honored. I'll put that honored. And Senator Roth from Delaware was the chairman of the House Ways of the Senate Finance Committee, and they were doing tax cuts, and somebody said, you know, we have to come up with some source of revenue to balance this legislation. So somebody came up with a non-deductible IRA. That's what this is. It's a non-deductible IRA, and because it was considered a revenue raiser, because it was encouraging people to take money out of their taxable IRA, make a distribution, and put it into a Roth IRA, creating taxable income and therefore balancing this tax law. And don't forget, there's multiple trillions of dollars at this point of taxable income locked up in IRAs. And this was and the Roth IRA was, or this non-deductible IRA was a vehicle for unleashing this, opening the dam for of all this taxable income. But because it was a revenue raiser, no politician wanted their name on it. They only want their name on the good things, right? The buildings and bridges and what have you. And Roth had to go to the bathroom, and when he came back, it was the Roth IRA. I'm told it's a true story. Well, it makes for a good story anyway. It's a true story. Roth conversions and taxes are on sale. This is one of the most wonderful planning opportunities we have. If you take nothing else out of tonight's talk, just remember Roth conversions. It makes sense now more than ever. And the reason why is because taxes are on sale. Question?
With the Roth, if you have a regular IRA, what's the maximum you can transfer over to the Roth?
Unlimited.
What?
Unlimited Roth conversions. I've had $1 million conversions. You can only contribute if you're over 50, 50 or over 5,500 next year. It's going to be, 6,500 next year is going to be 7,000. But the conversion is unlimited. The government wants you to convert. They want you to convert as much as you possibly can, right?
Sure.
Okay. Now, taxes are on sale. This is a wonderful time to do this if you have, I'm not going to ask for any hands on any of this stuff because I know that's all private information. But if you have an IRA, a taxable, a regular IRA, this is something. Welcome.
Hello.
You're just in time. This is a fantastic planning tool, a Roth conversion. Now, a lot of people are going to say, what? You're my tax advisor? You tell me to pay more taxes? What kind of a tax advisor are you? I'm saying a little more taxes now and save a lot more taxes over the generations. I say taxes are on sale because, well, we saw this has been lower the brackets a little bit. And an expansion, lower the rates and expansion of the brackets a little bit. But I look back from World War II, from 1944 to date, 40 or 45, maybe even 44, to date. The rates we have today have only been lower in how many years of the last 75 years? 15. For 60 years of the last 75, the rates have been higher. So what I am saying, taxes are historically low. We're in the 5th quintile of tax rates historically. Are they going to go lower? First of all, this bill is unpaid for. When there's a change in the government that becomes fiscally more responsible, and we have trillion-dollar deficits that the Fed Reserve projected for the next 4 to 5 years. This was unpaid for at $1.5 trillion. Debt is at an all-time high. Is it logical to think taxes are going to be reduced? No, I don't think it's logical. No one has a crystal ball. Nobody knows what goes on in the minds of Congress people. But we do, but we're not going to say it. And all of them. I'm not picking on anybody. But there's no better time. Well, first of all, you can't go back. There's no better time than now and going forward than to consider a Roth conversion. Now, it's not one size fits all. Everybody here, if there's 20 people here, there are 20 different scenarios. Forget what I'm saying. It's what your individual facts and circumstances are that will dictate whether you should consider a Roth conversion or not. And it's not just your present situation, but as you go into retirement, what's the situation there? What about in your estate planning? Who's going to end up owning all of this when we pass on? You know, so there's a lot to consider. So one size does not fit all. Okay? Yes.
So what's the number, what is the percentage? Is that, if you convert your IRA to a Roth, that is then taxed, it goes towards your income and then you're taxed?
It's considered, any distribution out of a regular traditional IRA is ordinary taxable income added on, and it goes into your top bracket.
Right.
There's no, even though most of the income generated in an IRA are qualified dividends and long-term capital gains, it's all ordinary income. Yeah, back to you.
So regarding taxes on heirs, is there not an exemption of estate tax below a certain threshold?
Are you talking about the $5 million exclusion? Yes. The estate tax was increased. Well, we remember years ago when it was $600,000 a person. It has grown back and forth. There was one year there was no tax. The year Steinbrenner died in 2010 with $1 billion of taxable estate had no tax. But then it kicked in again. And now under this law, it went from, well, whatever it went from, it's up to, it went from 5 to 10 million, so a couple could get $22 million of a tax exclusion. However, if you're, let's be realistic. Let's say your estate is $1 million, and you have a $100,000 IRA in that estate, and everything is there's no federal tax and there's no Vermont tax, you know, because you're under the thresholds on both of those, but the IRA is inherited by your daughter. It becomes an inherited IRA in the hands of your daughter. This money has never been taxed. When she starts taking it out, and you have to start taking out an inherited IRA no matter how old the beneficiary is. I have a 10-year-old who has to start taking inherited money out. That's ordinary income. There's no estate transfer tax, but there is an income tax to the beneficiary of a traditional IRA. That's why, what a wonderful gift you can give your beneficiaries of a Roth. They have to start taking it out. There's still required minimum distributions of a Roth IRA, but it's not taxable.
It doesn't increase their tax.
And the interesting thing is that if you don't take it, there's a penalty for not taking it. 50%, 5-0.
Wow.
So,
Are the withdrawal requirements for a Roth the same as for an IRA at 70?
no. A traditional IRA, the account owner of a traditional IRA is required to take distributions in the year in which they turn 70 and a half. Okay? Now you have, in that first year and first year only, you have until the following April 1st. April to take it. But you also have to take the next year's too. So you may be doubling up. That's because there's a little bit of a relief the first year in case you didn't know about it or this is new to you or something like that. With respect to an inherited IRA, there are two sets of rules. There's rules if the beneficiary is a spouse, and there's rules if the beneficiary is a non-spouse. If the beneficiary is a spouse, and there's a lot of other, I'm only going to give you the higher level, the higher layer of rules because we'll be all night with this. A spouse can treat this spousal inheritance and bring it into her own or his own IRA and treat it as their own. Now if the decedent was 70, didn't turn 70 and a half, and the spouse is 50. That makes sense for that spouse to bring it into her IRA, and she has 20 years of growth before she has to take it out. If it's a non-spouse, you have to start taking it out. But it's a calculation, it's a formula. You have to do, the formula is based upon the fair market value of the account as of 12/31 of the preceding year, and you have to, there's a whole equation of what's the year of, the age of the account owner. In other words, when did the account owner was born, when did he die, and what's the age of the primary beneficiary. It's a whole formula, but you have to start taking it out right away. You have a year grace, but it's basically every year.
Are there different rules on required withdrawals with Roth?
Yes, you still have to take the account owner never has to have a required minimum distribution on a Roth. Never. There's no 70.5 rule. However, if you inherit a Roth, you have to start taking required minimum distributions based upon this formula, but it's not taxable. But if you don't take it, there's a penalty. Okay? And then there's a lot of planning here because there's another rule for 59.5. If you take money out before you're 59.5 of an IRA, not only is it taxable, but there's another 10% penalty for an early distribution. So you have to be careful there too. The sweet spot for an IRA is if the account owner is between 59, because there's no restriction on, and 70.5. You can do anything you want. No, it's a penalty-free zone. Okay. Yes.
So if you have an IRA and you want to convert it, do you have to take the whole IRA?
No. You can take whatever you want. But if you are already over 70.5 and taking required minimum distributions, the Roth conversion does not qualify as part of your required minimum. You must take your required minimum and then take a Roth conversion over that. Okay? Good questions. Yes,
I'm not sure
Regina.
what the
Oh.
time is, and so I wanted to have an opportunity to have you give any really great bullets of information out. And
Okay,
we'll ask any
okay.
questions.
There's some highlights I want to go over.
Okay.
But this is, we've spent the money, we've spent the money, we spent the time where we should. This was good, because the two things I want to get over are Roth conversions. And there's so much you can do with that. And the other one is how we can take advantage of this increased standard deduction and losing all these other things, and how we can benefit from that. Here's the estate tax changes. The exemption is 11.2 for a married couple. When I say for a married couple is 22.4, that means when the first spouse passes away, let's say the spouse has a $5 million estate. He has an unused $6 million exemption. Under the portability rules, that $11 million can be transferred to the remaining spouse, and the remaining spouse can get 15, 16 million. If you're in that league, then you'd have an estate attorney talking. You'll already have an estate attorney, like you, Ed, right?
Oh, yeah.
Yeah. Okay. In 2018, the annual gift tax exclusion went up to $15,000. That's very important. Estate planning. Estate planning is very important. Again, estate planning is maximize the family's net worth, the multi-generational family's net worth, or whoever you consider to be in that family, which could be charities and what have you. So it's important to, we'd like to say every 5 years at a minimum, we review everybody's estate documents, or if there's any life-changing event, there should be a review of documents. And also, with people moving from state to state, and I have so many people in Florida, it's important to do this under the law of the state in which you are a resident. Your Vermont will may not be good in Palm Beach, may not be what you wanted it to say. It probably does, but you want it to be under the local jurisdiction. And also, okay, so I'll jump along. Educational tax benefits on the 529 plans. We do a lot of 529 plans for grandchildren, and in the previous slide we had a $15,000 annual exclusion for a gift. For 529 plans, a grandparent, for example, can accelerate 5 years of gifts and give $75,000 the first year when that baby is still in the nursery in the hospital. But nothing for the next 4, you know. But then it's a jump start. When 529 plans became fashionable years ago, most firms that had them had limitations. It was about $200,000, $250,000. That's all you could put in, because that was the average cost of a 4-year college, maybe graduate school. You know, I just opened one this morning. Schwab, I will deal with Schwab. Schwab has a $420,000 limit, because that's now the average cost of. So 529 plans are very good tools. Yes, Troy.
Well, and the question is, it's not a limit of 15 if you're a couple, because then it's 30,000 per child for a married couple for 5 years. That'd be 150.
You can have marital, yes. Okay, individual tax changes, casualty losses are out the window, unless it's a federally declared disaster area, because they're all becoming federally disaster areas. Alimony, if you're going to get divorced, do it before the end of this year, because starting in January, alimony payments are no longer deductible. However, alimony recipients no longer have to pick it up as taxable income. So.
But the old law would be grandfathered?
Yes, yes. Any decrees up through executed by 12/31/18 have the old laws. No more moving expenses. If anybody has corporate transfers, you may be. Kitty tax rates. A lot of people used to put securities and things into their kids' names because their tax rates was nothing, you know, practically nothing. But if it hit a certain level, about $1,400 or so, it had to be taxed at the parents' level. Now it's taxed at the trust and estate level, which is awful. You never want to be subject to that. Whereas the 37% for a married couple, that starts with $600,000 of taxable income. The 37% in a trust is at $13,000. You don't want to accumulate income in a trust, ever. Having said that, I'm sure there's a lot of exceptions.